If you receive Social Security and you stopped withholding federal taxes this year because you heard the tax was completely gone, you may already owe the IRS money you have already spent. I am not saying that to scare you, so subscribe to this channel, share this video. I am saying it because in July 2025, the Social Security Administration sent an official email to millions of American seniors saying, and I quote, that the new law eliminates federal income taxes on Social Security benefits for most beneficiaries. Seniors across the country read that email, believed it, and made real financial decisions based on it. Then that blog post was quietly removed because it was wrong. The government's own agency sent millions of retirees incorrect information about their taxes, and most of those retirees still do not know it. Now here is the number that should make you stop scrolling right now. If your combined annual income exceeds $34,000 as a single filer, up to 85% of your Social Security benefit is still fully taxable in 2026, the same as it was before any new law was signed. Nothing changed that. And in the next several minutes, I am going to show you exactly where you stand, with real numbers and a real example, so that you are not caught off guard when tax season arrives. Do not click away, because finding out in April what you should have known today could cost you hundreds of dollars straight out of your retirement savings. Here is what actually happened. During the 2024 presidential campaign, Donald Trump made a bold promise. Seniors should not pay taxes on Social Security. It resonated with millions of retired Americans living on fixed incomes. Then, in July of 2025, Congress passed and the President signed the One Big Beautiful Bill Act, also known as the OBBBA. And here is the truth that far too few people are saying out loud. The One Big Beautiful Bill Act, the OBBBA, did not eliminate, repeal, or remove federal taxes on Social Security benefits. Not even partially. The federal tax structure that has governed Social Security taxation since 1993, the one where up to 85% of your benefits can be federally taxed, depending on your income level, that structure is completely intact in 2026. Nothing about the underlying tax law changed. What the OBBA did instead was create something called the Enhanced Senior Deduction, also referred to as the Senior Bonus Deduction. The Enhanced Senior Deduction, or Senior Bonus Deduction, gives taxpayers who are 65 years of age or older an additional $6,000 in standard deduction on top of what they were already receiving. For a married couple where both spouses qualify, that amount is $12,000. This is real financial relief for many lower-income seniors, and I do not want to dismiss it, but it is a deduction, not an elimination of the tax. And that difference is exactly what can catch you off guard at tax time. Now, before I go further, I want to say this directly. If you find this kind of honest, detailed breakdown valuable, please subscribe to this channel right now and share this video with any retired person in your life who receives Social Security. The information I am about to cover in the next several minutes is information that the headlines are not giving people clearly, and your family members and friends deserve to hear it. And with that said, let me walk you through exactly how the tax actually works in 2026, so you can see your own situation clearly. The IRS determines how much of your Social Security is taxable using a calculation called your combined income. Your combined income is calculated by taking your adjusted gross income, which includes things like pension payments, IRA withdrawals, rental income, and wages, then adding any tax-exempt interest you received during the year, and then adding back exactly 50% of your total annual Social Security benefit. That final number is your combined income, and the IRS uses it to place you into one of three zones. If your combined income as a single filer is below $25,000, none of your Social Security benefits are federally taxable. If your combined income falls between $25,000 and $34,000, up to 50% of your Social Security benefits may be subject to federal income tax. And if your combined income exceeds $34,000, up to 85% of your Social Security benefits can be federally taxed. For married couples filing jointly, those same three zones begin at $32,000. The middle range runs from $32,000 to $44,000, and the 85% zone applies to any combined income above $44,000. These thresholds have not been adjusted for inflation since they were first set in the 1980s and 1990s, which means more and more retirees fall into the taxable zones every year simply because of COLA increases, even when their real purchasing power has not improved. Let me make this concrete with a real example. Meet Robert. Robert is 71 years old, retired from a manufacturing job in Michigan, and receives $2,100 per month in Social Security. That is $25,200 per year. Robert also takes $18,000 annually from a traditional IRA and receives $4,800 from a small pension, bringing his non-Social Security income to $22,800. To calculate his combined income, Robert adds his $22,800 in other income to half of his Social Security benefit. Half of $25,200 is $12,600, giving him a combined income of $35,400. Because $35,400 exceeds the $34,000 threshold for single filers, up to 85% of Robert's Social Security benefits are subject to federal income tax. That means up to $21,420 of his Social Security income could be taxable. Now here is where the enhanced senior deduction, the senior bonus deduction, comes in. Robert is 71 and qualifies for the additional $6,000 deduction, which reduces his overall taxable income and lowers his tax bill. That is genuinely helpful. But Robert is still paying federal taxes on a portion of his Social Security income in 2026. Because the tax itself was never removed. If Robert believed the "no tax on Social Security" headlines and stopped his voluntary withholding, he is going to owe money at tax time that he was not expecting. And that is the exact situation this video exists to help you avoid. Now there is a critical detail about the enhanced senior deduction, the $6,000 senior bonus deduction, that the news coverage almost never mentions. It is not available to every senior. This deduction comes with income-based eligibility limits that phase it out and eventually eliminate it entirely for higher-income retirees. If you are a single filer and your modified adjusted gross income, your MAGI, exceeds $75,000, the deduction begins to phase out on a sliding scale. If your MAGI as a single filer is above $175,000, you receive none of this deduction. For married couples filing jointly, the phase-out begins at $150,000 in combined MAGI, and the deduction is completely gone above $250,000. Your modified adjusted gross income, your MAGI, for this senior deduction is essentially the same as your adjusted gross income for most domestic retirees. The only items added back are foreign earned income exclusions, which the vast majority of seniors will never have. So for most people receiving Social Security and pension or IRA income, MAGI and AGI are the same number. Still, confirm this with a tax professional before assuming you qualify for the full amount. And beyond the income limits, this deduction is also temporary. It applies to tax years 2025 through 2028. After 2028, unless Congress passes new legislation to extend it, the enhanced senior deduction expires entirely, and your tax situation will revert to what it was before the OBBBA passed. There is one more layer to this that most people are not discussing, and it concerns state-level taxes on Social Security income. Because even if the enhanced senior deduction completely wipes out your federal tax liability, even if you owe $0 to the IRS, you may still owe state income tax on those same Social Security benefits, depending on where you live. As of 2026, 8 states continue to tax Social Security income in some form: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. Each of those 8 states, Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont, applies its own rules, its own exemptions, and its own income thresholds. The federal enhanced senior deduction has no direct effect on your state tax obligation. So if you live in one of those 8 states and you went through this year believing your Social Security was fully tax-free, you need to speak with a tax professional in your state as soon as possible to understand exactly what you owe at the state level. Now I want to give you 3 concrete action steps you can take right now. And this is the part of the video where I need you to pay close attention, because this is where knowing becomes doing. And before I give you those steps, I want to remind you one final time. If this video has been helpful to you, please hit subscribe and share it with one person in your life who receives Social Security. You have the ability to protect someone you care about from a very avoidable financial mistake just by passing this along. The first action step is to check whether you are currently withholding federal taxes from your Social Security payments. When you receive benefits, you can voluntarily request that the SSA withhold a percentage of each payment by filing Form W-4V, the Voluntary Withholding Request Form. The available withholding rates are 7%, 10%, 12%, and 22% of your monthly benefit. If you canceled your withholding because you believed the tax was gone and your combined income places you in a taxable zone, you should strongly consider restarting that withholding immediately. You can update your Form W-4V by visiting your local Social Security office or by mailing the completed form directly to the SSA. The second action step is to calculate your combined income before tax season arrives. Use the formula I walked through earlier. Take your adjusted gross income, add any tax-exempt interest, then add 50% of your annual Social Security benefit. Compare that number to the thresholds, $25,000 and $34,000 for single filers, $32,000 and $44,000 for married couples. This calculation takes about 10 minutes and gives you a clear picture of whether any of your Social Security is taxable in 2026. Do not wait for your accountant to surprise you in April. Run these numbers yourself today. The third action step is to verify your eligibility for the Enhanced Senior Deduction, the $6,000 senior bonus deduction, before you count on it in your tax planning. Confirm that you are 65 or older. Confirm that your modified adjusted gross income falls below the phase-out thresholds, $75,000 for single filers and $150,000 for married couples. And if you are close to those limits, speak with a qualified tax professional who works specifically with retirees and Social Security recipients. Do not rely on a general tax preparer who may not be familiar with the full picture of how the OBBBA interacts with Social Security taxation. The stakes are too high and the details are too specific for a generic approach. One thing that makes this situation particularly frustrating for retirees is that the income thresholds used to calculate how much of your Social Security is taxable have never been updated for inflation. When Congress first introduced federal taxation of Social Security benefits in 1983, the original thresholds were set with income levels of that era in mind. Then, in 1993, the 85% tier was added with a $34,000 threshold for single filers. Neither the original thresholds nor the 85% threshold has been adjusted in over 3 decades. What that means in practice is that every year, as Social Security COLA increases, push monthly benefits slightly higher, more and more retirees cross into the taxable zones. Not because they became wealthier, but simply because the thresholds are frozen while their benefit amounts slowly rise. A senior who was just below the taxable threshold 3 years ago may now be above it purely because of annual COLA adjustments. This is sometimes called bracket creep, and it is a quiet, automatic way that more of your Social Security becomes exposed to federal taxation over time without any new legislation required. That means even if you checked your tax situation a few years ago and found you owed nothing on your benefits, that calculation may have changed, and you need to run the numbers fresh for 2026 specifically. There is also one practical detail about Medicare that every Social Security recipient should understand, because it directly affects how you read your tax documents. If you are enrolled in Medicare Part B, your premiums are deducted directly from your Social Security payment before you ever receive it. In 2026, the standard Medicare Part B premium is $202.90 per month. That is approximately $2,435 per year, taken out before your payment hits your bank account. Here is where people get confused. The SSA reports your full gross benefit on your annual SSA 1099 form, your Social Security benefit statement, not the reduced amount after Medicare deductions. So when you calculate your combined income for tax purposes, you must use the full figure from your SSA 1099 form, your Social Security benefit statement, not what actually landed in your bank account throughout the year. If you use your bank deposit total instead, your combined income calculation will be lower than it should be, and you may think you owe less tax than you actually do. This is a small but costly mistake that trips up retirees every single tax season, and being aware of it now puts you ahead of the problem entirely. Here is the bottom line. The story of Social Security taxes in 2026 is a story about the dangerous gap between what was promised and what was actually delivered. The One Big Beautiful Bill Act, the OBBA, gave seniors a real financial tool: the enhanced senior deduction, the $6,000 senior bonus deduction, and for many lower-income retirees, that tool is genuinely meaningful. But it did not do what millions of Americans were led to believe it did. Federal taxes on Social Security benefits still exist. The 85% taxable threshold still applies above $34,000 for single filers and $44,000 for couples. 8 states still tax your benefits independently of any federal change, and the SSA themselves sent millions of beneficiaries an official email making this incorrect claim, an email whose accompanying blog post was later removed, which tells you everything you need to know about how clearly this policy was communicated to the people it affects most. You deserve accurate information. You earned those benefits, and you have every right to know exactly what the rules actually say. So subscribe to this channel, share this video, and make sure the people you care about have the same clear picture you now have. Because in retirement, what you do not know can cost you thousands of dollars.